Hello and welcome to your first day at Dow Jones University. I'm Professor Britt Baker, aka your favorite YouTube money coach, and today I'm teaching Investing 101. So pull out your pens and paper and get ready to take notes. Okay, jokes aside, I know that it can seem like people in the investing world are speaking a different language, but it's really not that hard to learn. All you need to know are a few key phrases to unlock the world of the stock market. If you want to learn more about how to build financial security, be sure to subscribe and hit the notification bell so you don't miss out on future videos. And if you really want to master investing, check out our free masterclass. I'll leave a link in the description below. All right, let's get into it. Here are 10 investing terms that you need to know. I'm going to speak to each one of these terms and provide some examples so you can really begin to understand them and can be on your way to being a confident investor. Okay, let's start with return. Your return is what you make or lose from an investment. It can be a positive or a negative number, as it refers to the gain or loss that happens after you invest over a specific period of time. For example, if you see an ETF that had historical returns of 5% over the past year, that means that if you had invested $100 at the start of the year, your investment would be worth $105 at the end of the year. Now, your return is typically expressed as a percentage, and it measures the profitability or performance of an investment over time. Returns are essential in evaluating the performance of investment. It's how you compare different investment options and assess the effectiveness of different types of strategies. Returns also provide insight into the profitability of an investment and help you gauge the risk and reward associated with a particular asset or portfolio. For example, stocks will tend to give you a higher return than bonds while also carrying slightly more risk. But more on that in a few minutes. All right, keep in mind, historical returns are not indicative of future performance. So just because something had 30% returns last year does not mean it will have the same returns this year. Okay, now let's talk about what you invest in to get a return. That is called an asset. So an asset refers to something of value that can be owned and has the potential to generate future economic benefits. For example, if you owned a chicken that laid eggs that you could then sell, that would be an asset. The chicken would be the asset. When it comes to traditional investing, there are lots of different types of assets, including but not limited to stocks, bonds, real estate, commodities. So I'm going to talk about each of those, but just know that there are tons of other assets that you can invest in as well. Okay, 1, stocks. Stocks represent ownership shares in a public company. But what does that actually mean? When you buy a stock, you buy a tiny piece of a big company. And then when the company does well, they either pay dividends to their stockholders or the value of your stock goes up. In general, stocks offer the highest potential returns, 7 to 10% on average, but they also come with more risk than other asset classes. Speaking of risk, let's talk about bonds. Bonds are effectively IOUs from either the government, municipalities, or corporations. And it's a way for these organizations to borrow money, also known as raising capital, in exchange for paying you interest. So when you purchase a bond, you're essentially lending money to one of these issuers in exchange for regular interest payments. Those interest payments then become your return. So bonds, since they usually have a set interest rate, are generally considered less risky than stocks, but they also tend to have lower returns than stocks. So when you think about bonds, you can think 3 to 5% on average for their return. All right, next up is real estate. Real estate refers to properties such as residential homes, commercial buildings, and land. Investing in real estate can provide income through either rental payments or the appreciation of the property value over time. And real estate investments can vary. It can be direct property ownership where you're renting out units, or it could be investing in a real estate investment trust where someone else is actually doing the real estate investing and you just own a piece of it. You could also invest in real estate funds. There are lots of different ways. And returns on real estate vary depending on the type of real estate investing that you're doing, and they can range anywhere from 3 to 15%. Commodities. Commodities are physical goods or raw materials like gold, oil, natural gas, agricultural products, metals. So instead of investing in a business or a property, you're investing in a specific good, like corn. Some people like to invest in commodities because they either want to bet on something specific or because commodities add diversification to your portfolio and help hedge against inflation. More on those topics in a moment. So now that you know all about assets and the different types of assets you can invest in, let's talk about how you decide what to invest in, which is called your asset allocation. So asset allocation is the process of dividing an investment portfolio among different asset classes, such as stocks, bonds, and real estate, to achieve diversification and manage your risk. Now, asset allocation is based on the fact that different asset classes have different levels of risk and return, like we just talked about. Stocks have a higher return while also a higher risk. Bonds, lower return, lower risk. And the idea is that when you're investing in the right mix of stocks and bonds, you can achieve the right level of risk and reward based on your goals, your time horizon, and your preferences. So, for example, if you plan to leave your money invested for 30 or more years, you can tolerate more risk. And that's because you have more time to ride out the highs and lows of the changing market. So when you invest in all stocks, your portfolio might go up and down depending on what the market's doing. And as long as you have a long enough time horizon to invest, you can allow the market to recover. So if that is the case where you have 30 or more years, you may choose to invest in a mostly stock portfolio. In this case, it may be 95% stocks and 5% bonds. Now, if you only have 10 years to leave your money invested, say until retirement or until you want to use the money to pay for your kids' college, then you might want to add more bonds to your portfolio, which will lower the potential returns but offer more stability since you have less time to ride out the ups and downs. So in that case, your asset allocation might be 70% stocks and 30% bonds. All right, now that you understand asset allocation, let's get into the gold of investing: compound interest. But before we do that, if you're learning a lot, would you give this video a thumbs up? It helps us make more content that you love. All right, compound interest is a truly magical concept that allows your money to start growing exponentially over time. We refer to compound interest as the avalanche of investing because once it starts, it just accumulates more and more really fast. And technically, compound interest is when you earn interest on your initial investment, which makes it grow, and then you keep earning interest on the new larger amount. So you can think of it as interest on interest. It has a compounding effect where the interest you earn is added to your investment, and over time it generates more interest. So let's say, for example, you invest a principal of $1,000 and you have an annual interest rate of 5% that's compounded annually. And at the end of the first year, so you earn 5% on $1,000, that's $50. So you earn $50 in interest, and the new total in your account is $1,050. So in that second year, you're gonna earn 5% on the new total, on the $1,050. So then you get $52.50 in interest. And that additional $2.50 is from the compounding effect. And this number gets bigger and bigger over time. So assuming the same rate of return, after 10 years, your initial $10,000 investment would grow to over $16,000 because of compound interest. Compound interest is a key factor in long-term wealth accumulation, and it can significantly amplify your investment returns. So it's something that you want to take advantage of. Quick spoiler, we have a full video coming out on compound interest, so subscribe and hit the notification bell so you don't miss it. All right, next up, let's talk about diversification. Diversification, as I alluded to earlier, is investing a lot of different things. It's basically spreading out your investments across different assets, asset classes, with the intention of lowering your risk. It's the same idea as not keeping all of your eggs in one basket. If you drop the basket, you lose all of your eggs. And we don't want that to happen with your investments. So you want to carry multiple baskets with your eggs in them, or multiple types of assets that you're investing in. So one easy way to diversify is to invest in funds instead of individual stocks. Funds allow you to bundle stocks or bonds and invest in many of them at once. So this automatically increases your diversification without much effort. 3 types of funds are mutual funds, ETFs, and index funds, and I'll speak briefly about each of those. A mutual fund is a fund that pools money from multiple investors to invest in a diversified portfolio. It's professionally managed by a fund manager or a team of managers who make decisions about what to invest in, and so it usually means that there are higher fees involved in investing in a mutual fund. An ETF, or an exchange-traded fund, is another type of fund that you can invest in that gives you instant diversification. And the benefits of an ETF are that they have much lower fees than mutual funds, and again, they give you this instant diversification. So they are designed to track the performance of a specific index, sector, commodity, or asset class. The other nice thing about ETFs is that they're traded on stock exchanges, so you can buy and sell them throughout the day on market prices, which is different from mutual funds, which you can only sell at the end of the day. So again, ETFs super easy to invest in and also have really low fees. I love investing in ETFs, and I've designed my entire portfolio using ETFs. If you want to learn more about this, we do have a specific video on ETFs, so I'll link to it in the description. All right, and then the final fund class is an index fund. So an index fund can actually be a mutual fund or an exchange traded fund, and it's designed to replicate the performance of a specific market index. So you may have heard of the S&P 500, the Dow Jones Industrial Average. These are indices. And when you invest in an index fund, it tracks that index. It's another easy way to add instant diversification and low fees to your portfolio. We do have another full video on how to create a diversified investment portfolio coming out in a few weeks. So if you subscribe, you won't miss it. All right, now that I've mentioned portfolio a few times, let's talk about what an investment portfolio really is. So your investment portfolio refers to your collection of financial assets. So your stocks, bonds, mutual funds, ETFs, real estate, all of your investments. And building a proper investment portfolio means selecting those different asset classes that align with your goals, your risk tolerance, and your time horizon. I'll go into those more in a moment. A well-diversified portfolio typically includes a range of investments. So you have investments across, say, different regions, say, different industries, or different asset types. All of those are different ways to achieve diversification in your portfolio. All right, now let's talk about risk tolerance and time horizon, two things I've mentioned a few times in this video. Your risk tolerance in investing refers to your ability to handle or accept uncertainty and potential losses associated with an investment decision. It's an important factor to consider when creating an investment portfolio and choosing what to invest in. Now, every investor has a different risk tolerance based on their personal circumstances, their financial goals, their investment knowledge, and their emotional capacity to withstand fluctuations in the value of their investments. So some investors are more willing to take on higher levels of risk in pursuit of potentially higher returns, while others prioritize the preservation of capital and seek lower risk investments. And usually you have a sense of whether you're a more risk averse or more risk tolerant person, and you can use this self-awareness as you build your portfolio. For instance, if you're more risk tolerant, you might choose riskier assets to invest in, like more stocks in your asset allocation, maybe cryptocurrency. If you're more risk averse, you might choose to increase the bond percentage in your portfolio or only invest in things you understand really well. So that's risk tolerance. Then finally, there's your time horizon. So in investing, your time horizon refers to the length of time you expect to hold on to an investment before needing to sell it and access the funds. And your time horizon can vary greatly from one investor to another. It really depends on your circumstances and your goals. So for example, if you're 60 and investing for retirement, your time horizon will be shorter than if you were 30 and investing for retirement. If you're saving money for your kids' college fund, then you have the number of years until they go to college as your time horizon. Your time horizon is another critical factor to keep in mind as you're making investment decisions. We talked about this during the asset allocation section. Why does this matter? So this matters because the longer you have before you need to take the money out, the more you can tolerate the ups and downs. So knowing you'll be invested for a longer time means you might be willing to take on more risk. Alternatively, if you need the money on a shorter time horizon, you likely don't want to risk the value changing too dramatically, so you might want to take less risk with your investments. Knowing your time horizon combined with your personal level of risk tolerance can help you determine an appropriate investment strategy. All right, great job, team. You have aced Investing Lingo 101. Give yourself a huge round of applause because you just learned a lot of investment terminology and you are on your way to being a confident investor. I'm excited for you. If you're ready to put this into action right away, join our free masterclass and we'll share some of the secrets of being a successful investor. I'll leave a link in the description and the comments below. As always, thanks for watching and I'll see you next time.